times have changed, and we've got a dollar that's weakened, gold that's strengthening, a yen that's now looking like a defensive asset. People need to heed that warning, and the market is going to react much differently than it has for the last couple years.
Welcome to the Monday version of the On the Tape podcast. Guy Adami, EYT, that's Elizabeth Young Thomas of SoFi, Dan Nathan back from California. Dan, how are you?
I'm doing great. You guys did a phenomenal job last week. I missed you guys on the market call and on the Friday edition of the On the Tape podcast, which actually dropped on Thursday. You guys had an awesome conversation with Mike Wilson of Morgan Stanley, Danny Moses, and yourself. So people, go to the podcast store. If you're not already following us, download that, rate it, review it, but also listen to it. It was a great conversation. And also, a little housekeeping. Guy and I are going to be down at Georgetown at the Pissarro Center for Financial Markets and Regulation. Guy's going to be interviewing the CEO of CME Group, one of our fine sponsors. He's also the chairman of that fine company. That would be Terry Duffy. And hopefully we'll get the audio and the video guy and jam that in the feed. And we're going to be doing Market Call this week, a special schedule. It's going to be Wednesday, Thursday, and Friday. So just a little housekeeping there. Liz, how are you?
I am well. It's Fed week. I'm excited. How are you guys?
We're doing well. And this is, you talk about the Super Bowl happens once a year, and it appears as though my team will not be participating yet again. However, this is sort of a Super Bowl week for you. And I think a lot of the excitement around the market last week sort of revolved around, I guess, sort of this refocus or this re-exuberation about a potential of 50 basis point rate cut, which, by the way, I don't see. I saw Richard Fisher on Squawk Box last week. He didn't see it either, but I guess a lot of people are starting to see that.
Yeah, so big week. Not only is this usually a Super Bowl week, we get 8 of these per year, but this is the really big kahuna because this is the first rate cut of the cycle. They almost made it to the longest pause ever. If they would have waited till the November meeting, it would have been the longest pause ever, but not quite with this one. So last week we got CPI. It came in pretty much on expectations, if not a little bit hot. So you saw the pricing in the market go back down to say 25 basis points is what we're getting. Now here we are. I'm looking at this live. We're at a 64-ish% chance of a 50 basis point cut. So chances have changed quite a bit, all because of commentary. So we had some former regional Fed presidents come out, Bill Dudley, talk about the fact that he would support a 50 basis point cut. Now, obviously, he's not a voting member, but we had 3 former Fed presidents talk about this last week. And there were some big articles in big financial publications about expecting a 50 basis point cut. I will say I have expected them to do a 50 basis point cut. And even if it's not an expectation, I think they should do a 50 basis point cut. And here's why. There's a break between this meeting and November 7th. It is a very long break. The entire month of October, the rest of September, there's a lot of data that can roll in during that break and make them look way behind the 8 ball. I think the risk of doing 25 and looking way behind now is bigger than the risk of doing 50 and trying to manage the message around it.
Yeah, I disagree with that, Liz. And respectfully, I just feel like between now and then, yes, there is a lot of data. And we also have a presidential election that might not be settled until that next Fed meeting. And I just feel like that, 25 makes some sense. They want to get this rate cutting cycle going. There's plenty of evidence that suggests that there's slack. And this was Greg Ip in the Wall Street Journal, I think yesterday. There's obviously slack in the jobs market. We're seeing inflation readings come down. We're seeing break evens come down. We're seeing crude oil come down. I mean, there's a whole host of things that suggest that they might be on their way to their target as it relates to inflation. And I'll just mention this, when you think of Lael Brainard, Deputy Director of the National Economic Council of the United States, I know Guy puts a lot of weight in titles like that and folks like that, but I guess there's a little saying that she has is like, when uncertain, start small. And when you think about this, and we talk about the long and variable lags of changes in monetary policy, we've been talking about the rate hiking cycle since late 21, right? And the market did not mind that for all intents and purposes. I mean, yeah, in 2022, but after that, with rates staying high, the stock market didn't mind for a whole host of reasons, and a lot of risk assets didn't either. So I just don't think 2 months are really going to matter. And I think it makes more sense to kind of stay pat. And you just said the CME Fed Watch tool is pricing in nearly a 65% probability of a 50 basis point cut, but that's just jawboning. You know what I mean? Like, I don't think is there any data to you that suggests that they have to be so aggressive so quickly?
Well, I guess if you want to play that card, you could say it in the form of the inflation data, which has been tame and obviously trending the right way for them. They'll point to the unemployment rate and say, yes, it's been climbing, but we're still at historically low levels. I mean, there's seemingly some slack now making its way back in. And so maybe they want to sort of get ahead of the potential for that to sort of hit escape velocity. And nothing's, if you think about it, things are sort of trending in the right direction for them. And, in terms of 50 basis points, to Liz's point, they want to get ahead of potentially some soft data coming in over the next couple months. The flip side, of course, is it will be politicized, whether people like that or not, without question. And then what signal does it say to the market in terms of sort of, is it a panic type of move? What I'll say, though, and what we're seeing right before our eyes, Elizabeth, is this yield curve is steepening in a pretty meaningful way. Now, I don't want to get crazy here, but, you had a historic level of time for the yield curve to be inverted. We got out of that, I don't know, a week or so ago. And now you're seeing what's happening to the 2-year yields. You have said it a number of times. It's the inversion, it's the wake-up call, it's the re-steepening that should concern everybody. And here we are in the re-steepening phase.
Yeah, it's the re-steepening, and it's the way that it re-steepens. If it's re-steepening because the short end is coming down faster than the long end, which is a bull steepener, which is only bullish for bonds, that usually means that people are starting to expect Fed rate cuts, which tend to be tied with a slowing economy, a cooling economy. We still sort of sit on this precipice of, are we too cool or are we at a perfect temperature? And I think right now we still are at a perfect temperature. It's a question of whether or not the beginning of cuts and the re-steepening of the yield curve will send it into a much cooler environment that they then have to play catch up on. One thing I would say about 50 basis points is that I think maybe the difference is I don't see it as aggressive. I don't see starting with 50 as very aggressive. I think that they'd still be quite restrictive if they took the upper bound from 550 down to 5, given where everything else has moved to and given the aggressive way that they moved up on the front end. And just like we talk about the yield curve, where it's not the inversion that gets you, it's the re-steepening. It's not the hikes that get you, it's the cuts. So this is a really sensitive time for the market. This is a sensitive time for the economy. And I think we're all going to be on the edges of our seats, obviously, to hear what they have to say. Much like most meetings, this one obviously will be about the commentary afterwards. The difference with this one is that it will actually be about the rate move too.
Yeah, Guy, let's bring it back to the stock market here again. 25 or 50, it'll be interesting to see how the market reacts. I think to your point that the stock market, the little boost that it had last week, aside from what Nvidia was doing to the tech complex, I think that a lot of folks were pricing in 50. So to Liz's point, and Liz, I don't disagree with you whether what they're going to do or not. It's kind of like the reasons, and that's obviously what's playing out in the stock market right now. And I think hopefully whether they go 50 or 25, they're going to get us a sense of like what the course might be and what will continue to guide that course. You know what I mean? Whether it's going to be a bunch of 50s or let's say 50 and then they wait and see what the data is. Who knows? Because I think you're right in the way that they don't want to be, perceived to be late to the game as they were back in 2021, you know what I mean, as it relates to inflation. Let's talk a little bit about the broadening out of the rally. There's lots of talk about how the XLU utilities are up nearly 25% of the year. Consumer staples are up as much as, let's say, the S&P or the NASDAQ. We know that, some of the Mag 7 has kind of been lagging of late. Nvidia was down a lot, had a big week. I think it was up 15% last week, and really no new news in my opinion. But let's just kind of like go through this a little bit. Apple today is down 3%. Apple was a huge lagger in the spring. Buffett was selling. We didn't know that until very recently. It was also not participating in this AI-fueled rally. June 10th at the WWDC, they introduced Apple Intelligence. A lot of investors got really geeked up. They really thought that that there's going to be this iPhone upgrade super cycle. So the iPhone 16 and Pro went on sale on Friday. Usually for 15 years, people track this very closely. What are the lead times, right? So if you get your order in on Friday and it ships the next Friday to you, usually over the weekend, the lead times will kind of move out a few weeks, maybe even a month in some situations there, because there's so much demand for it. And so this phone with the AI or Apple Intelligence on it, I just don't think the company has demonstrated why you need to upgrade for this. Now, we always hear that there's 200, 300 million iPhones that are 2-3 years old, and usually the battery starts crapping out or the processor gets slower, that sort of thing. And so it just doesn't feel like this is one of those upgrade cycles, because if you logged on right now to apple.com, you'd be able to get these phones again next week. So there's a lot of analysts out there, not a lot, there's a couple who are well followed or suggesting that maybe the demand is not going to be so great. And so, Guy, just really quickly, if I'm looking at Taiwan Semi, it's down nearly 2%. I just mentioned that Apple's down 3%, Micron's down 4%, Dell's down 2%. You say a bunch of those names really don't have much to do. Nvidia's down 2%, Tesla's down 2%. With Apple, Micron, Taiwan Semi, obviously due to some degree, it just seems like the broadening out away from mega cap tech and this AI trade continues a little bit. So my question to you is, if the iPhone is a bit of a flop right now, how important is that to the Mag 7 complex?
Well, I would have said it was extraordinarily important to that, and as we're sitting here, we're looking at an S&P that's effectively unchanged on a day that you just mentioned, when Apple is down, 3.25%, and probably is going to wind up being down a little bit more than that. Again, this goes back to what we talked about a lot this year, the fact that, as much as you'd like to think you needed Apple for the broader market, as it turns out, if you go back January into sort of middle of May or so, you really didn't need it at all, because Apple was a non-performer. So as much as I'd like to say, it has big meaning for the broader market and potentially the Mag 7, I'm watching the market here today, and it's seemingly shrugging it off in terms of the broader market. I will say this, though, since you mentioned those names. I mean, there's going to be some sort of knock-on effect in the form of, these ETFs, which all of these stocks find themselves in. And it's a great thing on the way up that all these stocks get dragged up as money flows in. But the same thing happens potentially on the way down. And I think you're starting to see it a little bit around the edges there. I also say this, that move we saw into Apple, I think into the middle of July, when it made an all-time high of about 237 or so, you had that obviously pretty precipitous drop on August 5th. We recovered a lot of it. We didn't recover all of it. And the fact that we probably only got back to sort of 229 or so, I don't know. People will say, maybe we failed at a prior high, and that's going to look sort of like what the S&P looks like as well. So I do think Apple has a level of importance. The market doesn't seem to be reacting to it today.
Speaking of those ETFs, something that I talk about a lot, we've got a semiconductor ETF right now down 1.2%. Now, we know that Nvidia is a very, very large weight in that ETF. And then compare that to the software ETF, which is up about 1%. Now, obviously, one day does not make a trend, but this is a pattern to watch. So if the rest of the market has rotated defensively, meaning utilities have led, we've talked about this already on this show, utilities leading, staples doing really well, some of the cyclicals coming back, hoping for that soft landing. Even within tech, you might be seeing a little bit of that defensive rotation out of semis into software. That's probably a temporary thing. If the market gets more scared, then money just comes out of tech entirely. But this is something to watch.
Yeah, Guy, it's interesting. I was out at the Goldman Sachs tech conference, and so David Solomon, the CEO of that company, sat down with Jensen Huang, talk about two power players right there. And it was interesting. The company reported on August 28th, and, investors initially were disappointed in what the company had to say. They were talking about this delay in Blackwell. This is the next iteration of this Hopper high-end GPU that people, companies have been clamoring for a very long time. Not just companies, but sovereign nations. We know that there's been restrictions about what they can sell to China on the high end. Nvidia had been working very hard to do workarounds. We know that there was a big gray market that existed out there for the Chinese companies to get access to these chips, and not just Chinese companies, but the Chinese government, right? So you have this delay. You have these companies that have been building these massive clusters of like supercomputers that use hundreds of thousands of GPUs, or at least tens of thousands. But Meta last week, I think this was the big driver driver. That, there was an announcement that Musk XAI had this 100,000 GPU cluster, this massive supercomputer, and Meta announced that they are building one now or nearly completed one. So when you have the buildup of those sorts of things, you're going to get these crazy orders. So you're going to have orders that have been outstripping, right, supply. This has been going on for a year and a half or so. I think that was the big driver of the outperformance in Nvidia, because Jensen Huang didn't say anything new. He said there's a lot of tension among their customers who want the Blackwell chip that has been delayed, but they didn't suggest anytime soon that that was going to be fixed. And the other issue, I think this is what investors took away, at least from the earnings call a couple weeks ago, was that this is going to be a lower margin ramp. One of the reasons why this company is up 140% in the year, it doubled last year, right? It had a $3 trillion plus market cap at its highs. I think it is probably right there too, is because the margins were going higher. And you've been talking about this guy, that they have been out earning because of this tremendous demand or so. So to have that sort of reflex action that they had last week on really no new news other than the Meta, I think there is risk to disappointment in this story if Blackwell is pushed out further into, let's say, 2025, guy.
Yeah, a couple things. So I think he used the term emotional when he was speaking about his clients or his customer base, which is an interesting term to use. I mean, this is a business. This isn't a relationship. Good for him. I get it. Maybe the world's changed. I'll say this as well. If you go back and look at what Oracle said, I believe it was Tuesday of last week. Don't at me if I'm off by a day, but that theoretically should have been very positive for Nvidia. And the knee jerk wasn't so much. Maybe the next day you got a little bit of a bounce. So what I think is happening here, Dan and Elizabeth, is you're getting the incremental good news without question, but you're not seeing sort of the commensurate move in the stock. And that's typically a sign where the market is now in the discounting portion of the good news. And I've said this for a while, and I'm not suggesting I'm right, but in terms of earnings and in terms of where they're trading price to revenue, they're sort of outkicking their coverage. And at a certain point, I think the market's going to wake up to that. Price to earnings is reasonable, and that's on the back of the margins that you just talked about. But if you start to see a deceleration in margins, then I think what's going to happen is the market's going to look at their price to sales and say, wait a second, this is too rich. At a certain point, this was trading, I think, 23 times revenues. It's come down a bit, but that's still probably double where it should be, at least historically.
So, Liz, this is kind of interesting. I'd love to get your take on this. So Intel is trading up, I want to say 4 or 5% today. It was up a bit higher in the pre-market, and they just qualified for a $3.5 billion deal from the Pentagon. It's kind of interesting, Guy. You've been calling this a sort of stealthy homeland security play. They've already gotten billions of dollars, or at least earmarked billions of dollars for the IRA, for the CHIPS Act here. And it's just funny. Like we talk about high-end GPUs, and really it's been AMD who's been like maybe the one that's going to have a product that can compete with Nvidia, but Intel is nowhere to be found on this, right? And the stock's trading at 10-year lows or something like that. Liz, how much do you suspect that we're going to hear more and more about this is like sovereign demand for chips, for obviously AI operating systems and the like here? Is this the next leg of this trade as people kind of normalize what the business aspects of are? Because we've been talking a lot about where is the ROI, right, for all of these investments from a lot of these companies. And it really feels like I had a great conversation last week with Jeff Richards, friend of the pod, on OK Computer from Notable Capital. Here's a guy who is an ex-software entrepreneur, sold a company, has been an investor, a VC for a long time. And we were going back and forth a little bit where a lot of VCs, they have to be optimistic about these new technologies because they're investing in things that they won't see a return on for 5, 7, 10 years or so. But we were talking about how it seems like this AI trade, because of the lack of ROI and use cases, might be going into this trough of disillusionment, largely because it's been very few names in the public markets that have benefited from this. And there's been a handful of names, obviously, in the private market that have seen their valuations skip higher, obviously OpenAI, Anthropic, and there's a few others. So talk to us about, do you think there's going to be a bit of a handoff, right, from some of these private sort of applications into the government? Is that the next line, do you think, of demand for these sorts of technologies?
Well, I think that would keep it alive in the short to medium term. I think that would be important for the trade. And you called it a normalization. I think it's a resetting of expectations. I think investors got way ahead of themselves expecting this AI trade to produce profits and produce ROI in the first 12 to 24 months. And obviously that hasn't happened yet. Now, that doesn't mean it's dead, but any theme like this is going to take a while to play out. And you're going to have new competitors come in or existing companies that become competitors that really weren't in the conversation before. I still expect that to happen. And you're going to find out new use cases. So if there is a really meaningful use case of this for a defense reason, then that would absolutely keep this trade alive. Now, maybe like you talked about it, we have to choose different companies around it and we have to look at it a different way, but it would give it a tailwind. Also, interesting that that's the case in an election year. Obviously, defense stocks, one of the most sensitive industry groups in an election year. So that should be an interesting thing to watch for the next couple months.
And it's interesting, defense stocks like the Lockheeds, the Raytheons, Northrops, they've actually been doing extraordinarily well in this environment. It makes sense. But there's something else that I've been watching, Elizabeth, and I'm curious as to your thoughts. Last night, sort of, I don't know, 10, 11 o'clock p.m. on the East Coast, dollar yen got down to about 140 and a quarter. So it actually was flirting with the 140 level. And as we're sitting here right now, it's either side of sort of 140.6, which again is lower than that August 5th level that we saw. I still think dollar yen, specifically the yen, is a story vis-a-vis what it means potentially for risk assets that the market's not paying enough attention to. And then sort of piggybacking on the back of that, gold continues to perform extraordinarily well. You obviously had the sell-off on August 5th. All risk assets got sold that day, but that sell-off in gold did not last long. So you have sort of the secondary stories of dollar yen, what the stronger yen means, and obviously what's been going on in the gold market, especially, and I'll let Dan sort of piggyback on your answer, Elizabeth, vis-a-vis Bitcoin, which has not been performing particularly well, Liz. So thoughts on that?
Yeah, well, I think it's connected. I think gold is connected to what's going on in the yen. I think gold is connected to all of the currency volatility that we've seen. And we know a lot about the carry trade between the US dollar and the yen. All people did was shift that carry trade to yen emerging market currencies. So it just moved around. The money just kind of got placed in a different spot. Now, that's a riskier trade. So I still think that there is more room for the yen to strengthen. I don't know if it's going to cause as much issue as it did on August 5th, but I still think there's more room for that. And I think it will continue to strengthen. There's actually speculation that the yen is becoming a defensive asset because of that strengthening and because of the Bank of Japan. Another speculation that they'll continue to raise rates. So times have changed, and we've got a dollar that's weakened, gold that's strengthening, a yen that's now looking like a defensive asset. People need to heed that warning, and the market is going to react much differently than it has for the last couple of years.
Yeah, it's interesting, that relationship. So the dollar really can't get going. It's tried to a little bit, right, over the last 2 weeks or so, and obviously that has to do something with as far as the expectations for a 50 basis point hike have been building. That's really been weighing on the dollar. We've also seen crude oil bounce back, right, with that dollar weakness. Now, here's the one thing, and Guy, you just mentioned Bitcoin. It can't get out of its own way. Gold keeps notching to new all-time highs, it seems like, every day, right? And, being helped by that dollar weakness. And I'm sure there's some stuff going on with the carry trade that's obviously got people's antennas up. But look at Bitcoin, the series of lower highs and lower lows. And you just mentioned August 5th, Liz. That thing in a panic traded down to 50,000 on August 5th, right? It recovered just like the stock market did. It appears to be very correlated to the NASDAQ or the Mag 7, which actually makes it a less interesting risk asset, right? A lot of folks were saying, as a pillar of the bull case of Bitcoin was that it was this store of value. It's like nerd gold and the like here. And it's proving not to be, which I just think is really interesting. But for us, we still look at it because it's $1 trillion, risk asset and the like. So I just find the differential between what gold's doing and Bitcoin's doing, and obviously relative to the dollar, a very interesting sort of thing. Guy, any thoughts on Bitcoin? Is it something that's still on your radar?
Yeah, I think you're right in bringing it up. I also think the divergence between what's been going on in gold and Bitcoin is interesting. Obviously, I've thought for a while, there's really no correlation that I can see. And, it has not traded particularly well. Now, people say, what are you talking about? If you look at it historically, This has still been an incredible performer. I'm just talking about in terms of what we've seen since March of this year. You had that huge move up to 73,000, the subsequent sell-off. You had another bounce probably in late April, early May, back to about 72,000. Another sell-off into July. Another bounce into the late July up to about 70,000 or so, and then the subsequent sell-off. So this move since early spring or late winter has been disappointing against a backdrop of obviously equities doing extraordinarily well, but gold doing well as well. So I'm not really sure what Bitcoin is trying to tell the market right here, but I'm laser focused on it in terms of it being risk on, risk off, especially when I compare it to what's been going on with gold. I think gold is differentiating itself for the first time in a while, and I think the gold move is going to continue.
All right, Liz, this is one I think that you're going to get to nerd out about, and then Guy is going to have a little fun with. So there's not a lot of earnings this week. General Mills, this is a packaged food company, is reporting, I think Wednesday before the opening. The price action in this thing has been really fascinating over the last 2 years. It sold off from an all-time high about a year ago, and it sold off about 33%. Okay, then it started to base a little bit, and over the last month or two, it's rallied about 20% or so. Now, we know that there's been a lot of talk, right, about shrinkage and food pricing and food inflation and the like here. And so when I think about this name, it might be a really interesting report and hear what their commentary as it relates to, there's been a lot of political wrangling about, gouging, price gouging and the like here. But what's interesting about this? When I look at this company's earnings, they're basically flat. You know what I mean? They've moved, nothing over the last few years. Their margins have been stuck at like 34, 35%. This is a $20 billion revenue company. It's a $40 billion market cap. And I think that this might be a stealthy one to watch. I'm just curious your thoughts here in general. But again, like if you look at their earnings, you look at their sales, you look at their margins, there's nothing going on other than a very volatile stock over the last few years.
Yeah, I mean, obviously falling in the staples sector, I think it is interesting to watch. Now, you also want to watch the dividend on these stocks. I think a lot of it is being driven by dividend payers. So the fact that utilities has done well, staples have done well, I think dividends are a big part of that as yields come down. And as we've seen the yield curve do this bull steepening thing, dividend stocks do tend to outperform. Now, staples have been in overbought territory, according to RSI, for a while. They got to overbought territory and then became even more overbought. So just because they got there doesn't mean they're due for this big sell-off, but it's just something to notice. That's why right now in the defensive category and in the dividend paying category, I'm still a Utes gal.
If you look at this, General Mills specifically, I think they reported the fourth quarter in June, and a lot of analysts came out. They basically were saying that, General Mills has reached the show me portion of this equation where, if you look in terms of organic growth, was down 6% last quarter. The street was sort of at negative 3.5%. Organic growth is basically code for we're passing on our costs to you. And it doesn't seem like they're able to do that anymore, number one. Number two, to your point, Dan, I mean, this is a company that, you could say it's reasonable on valuation, but they're basically going to do about $4.50 of earnings this year. Maybe they're going to do $4.70 next year. Revenues of $20 billion this year, maybe just north of $20 billion next year. So it's not like you have this huge growth driver behind it. And it comes down to, I think, margins and can they continue to pass it on? I think if Carter were here, which he's not, he would say maybe we're sort of doing this bearish to bullish reversal. And if you look at what I'm talking about, having troughed in October of last year, it's been basically trading sort of sideways to slightly higher. So maybe it's re-exerting itself to the upside, but there's not a lot to get excited about other than what you might be able to glean from their report in terms of what they're able to do and can't do in terms of pricing and passing it on to the consumer.
Well, here's something that investors are getting excited about. That would be these telcos. And talk about bearish to bullish reversals. Carter, I think, detailed the move in Verizon breaking out after this long base. I think he had a bullish call on that last week that we detailed on Market Call. But look at this AT&T. And you look at the dividend sector that Liz just mentioned. This is a 6% dividend, and it hasn't gone down that much despite the stock rallying 38% 8%. It looked a little unhealthy when it was yielding, I think, 7.5% or so. Verizon's got a 5% dividend deal. But you would think that AT&T a few months ago just announced that they have this amazing Gen AI strategy. The way this stock has moved, I mean, it looks like the utility sector for all intents and purposes. And so when I think about AT&T and Verizon, yeah, you can think about them as defensive with those dividends and the like here, but you also want to think about the thing that we started this conversation with. iPhone sales, right? They're the ones that are the biggest resellers, at least in North America, of these phones, right? And it draws a lot of the, these added fees that you're going to get for services and the like here. So it's interesting that they're trading off other things, you know what I mean, as it relates to how people are thinking about the stock market valuations, yields, and the like here, but it's not trading off fundamentals yet. So it'll be really interesting to see after this phone ships next week and what some of the commentary, I think a lot of analysts want to wait until they hear some sort of indication, right, in the supply chain or from the reseller chain about what the phone sales look like. You also, I want to make the point that usually after a week or so after these phones ship, you'll hear stuff out of the supply chain. Sometimes Apple will pull back orders for some like chips and memory and the like here, or slow down the builds of the device, because what they don't want to do is have a lot of inventory, right? So again, I just think it's interesting that Verizon and AT&T are not trading off of fundamentals, guys.
On the way down, they were trading off fundamentals because the fundamentals were miserable. I think this bounce is exactly what you just talked about. And I do think, as Elizabeth points earlier, I mean, there's this fleeing or flocking to this perceived defensive portion of the market, including high dividend pairs like Verizon and AT&T. So there's probably something around that. I don't think that's particularly healthy, but just to play in the space real quick, the name that's obviously exceeded them all continues to be T-Mobile, which is something we've talked about seemingly for years, which today, Monday, again made a new all-time high. Now, T-Mobile has been a monster. You're right to point out Verizon and AT&T have bounced significantly, but if you look historically where those stocks made their all-time high and where T-Mobile is now, there's no competition whatsoever.
All right, so we just mentioned that Guy is going to be interviewing Terry Duffy of CME Group tomorrow at Georgetown. Jamie Dimon's also going to be there, which is kind of interesting, and he's kind of been a little vocal over the last couple weeks or so. Guy, we had that dramatic move in JPMorgan relative to the other money center banks here, and this thing really hasn't found too much footing from that recent all-time high. I want to say it was like either the first day of September or late August. Thoughts quickly on what you expect the day before the Fed meeting, what Jamie Dimon might have to say to this audience. Because again, this is for, I think, financial markets and regulation and policy. That's the name of the Pissarro Center here. And this is what I think the main focus of a lot of these speakers tomorrow.
Yeah, but inevitably something will come out about his view on, the backdrop and the economy and what's going on. And he's been quite, I think, I think concern's a fair word to use for the last 18 months to 2 years. And some of his concerns have been founded, some maybe not so much, but maybe it's just a matter of time. So I do think that will come out in terms of his view on things. I'll also say this, the stock's trading JPMorgan 207 or thereabouts. It was around 202 or so a few months ago when, in response to a question that he was asked, said, his stock was rich in this environment. They probably weren't going to buy stock back. And, I took that as a sign that he's sort of seeing what a lot of people are seeing as well. It's a great franchise, but it was trading at valuations that last time we probably saw were pre-financial crisis. With that said, maybe the stock got down to 193 or thereabouts, and then it proceeded to make, like many things, a new all-time high over the last couple of weeks. I think there still should be some concern around banks, not necessarily JPMorgan, but some of these other names. Obviously, Goldman Sachs made some comments about their trading franchise that took the stock down last week. Bank of America even has some sort of cautious commentary as well. Not manifesting itself in the prices yet, but I think it's just a matter of time. And again, before we get out of here, just look what Warren Buffett's doing in terms of his Bank of America holdings. I think that sort of tells you all you need to know.
Yeah, what's interesting, I mean, if you look at what's happening in the banks today, most of the big money center banks are up pretty healthy, above 1%, but the 1 month return on a lot of those down 3 to 4%. And that's on the heels of a 2 year yield and a 10-year yield that's fallen quite a bit over that period. So a lot of these banks get a tailwind from the expectation of net interest margin going up. So it's interesting that in a steepening yield curve environment, if they are seeing headwinds, that to me sends more of a concern about cyclicality signal rather than something that's all excited about yields coming down.
All right, Guy, we covered a lot of ground here on a Monday. It's going to be a big week here. You have an S&P that's up, 18.25% or so, which is really interesting. It's outpacing the NASDAQ. That's not something we've seen a whole heck of a lot, especially when you think of like some of the biggest contributors to the NASDAQ. But I'll just make this point again. Apple is only up 11 or so percent on the year. Microsoft's up 15% on the year. Google's up 12.5% on the year. Tesla, we know, is down on the year. The only Mag 7 names that are acting well are Meta and Nvidia, So like the fact of the matter is it feels like this trade is losing some steam. We've talked about how Micron and Dell and Supermicro and a few other names that are thought to be like kind of beneficiaries of this trade, have been round tripping their entire move since they joined the party. I'll throw AMD in there. It's only up 3% on the year. Taiwan Semi is obviously still up a lot. They make 85% of these high-end GPUs, but it'll be interesting to see the reaction to what the Fed does. If it's only 25 and surprises the market, which is crazy to think about, that would be surprising the market right now, and what that means for this tech trade, which also, you brought up the yen carry trade, you brought up where it's trading. I mean, that was a level that kind of got investors really nervous about some of these high valuation names that have been a beneficiary of the carry trade, Guy.
Lot to look for this week. Obviously, all eyes on the Fed without question. It's going to be interesting to see. I would posit that the market might actually sort of trade more favorably to only 25 basis points. But what do I know at this point? I think everything is a bit of a crapshoot. I think people have gotten themselves excited about the potential of 50. But as I've said for a number of times, many times, Liz, be careful what you wish for in terms of these Fed rate cuts.
That's right. Big week.
Big week. Liz's Super Bowl. It happens, 10 times a year, guys. So I can't wait to see her on the closing bell, breaking it all down. I think this could be like one of those inflection weeks. Again, we know that there's generally a lot of volatility in the months in and around a presidential election. So again, strap in, people, because this could be a fun one. Thanks a lot for being here. Check out the pod with Mike Wilson. Very interesting conversation, Danny, Guy, and Mike. Also, Market Matrix comes out every day after the close. 10 of the kind of most important topics that Guy and myself and our team, we jam it into Perplexity. We get a summary of it. You get to hear it from our main man, Brunson. That is a voice bot. You don't even have to listen to Guy and me. So check that one out too. Liz, thanks for being here. Guy Adami, I'll see you tomorrow down at Georgetown.